the weighted average cost of capital. So weighted average cost of capital. Remember, so we talk about the retained earnings to finance the common stock portion of the capital structure. So you have a capital structure, and it's going to be using this function. Use this function. Let me open a new Excel spreadsheet. Excel spreadsheet. This is going to be the weighted average cost of capital.
Why?
Huh? Questions? Weighted average cost of capital. And for you to calculate the weighted average cost of capital, you will see this is the weight of debt. Okay, the WT, WT and D. This is the weight of debt. The weight of debt, and this is the preferred stock. This is the weight of preferred stock. The weight of preferred stock. And this is the weight of common stock. Of common stock. That's what we talked about before when you have a packing order series. So the weight supposed to be 100%. If you have the weight of debt, for example, 30%, the weight of preferred stock, 10%, the weight of common stock will be 60%. Okay, so when you sum them up, you say all those weight has to be equal to 100%. When you sum them up, so the total has to be 100%. So that means your total asset can be classified into 3 different categories. Debt, common equity, and preferred equity. So those are 3. So when you do this, so or you using a pie chart, the pie chart will see this is a preferred stock, and this is your debt, and this is your common equity. In total will be 100%. So the total 100% is your asset. Okay, so I wanted to show you how to get to the weight of the asset from the balance sheet. Let me show you a question we have. let's see, we have from here, we did. Okay, we use this. We have a makeup question. We wanted to show you for this question. And you can see this is your asset. Let's see, December 2015. So your asset, including cash, marketable securities, net receivables, inventory, prepaid. That's your total asset, including your current asset and fixed asset, right? Fixed asset. So you can do is that you have this. I want you to have a general idea how to get the weight of each type of asset. Okay, for 2015, so you can see your total asset. Total assets. Okay, your total asset equal to your cash plus marketable security. This is your cash plus marketable security plus net receivables plus inventory plus prepaid and plus this is a gross property, plant and equipment. This is a depreciation. So using this gross plant, property and equipment exclude your depreciation. That's your net fixed asset. Okay. Use the net fixed asset. Do not use the gross plant, property, and equipment. That's a gross fixed asset. So that's giving you the total asset is this much. Okay. So because this is the balance sheet, okay, some of the students come here late. You don't know what I'm talking about. This is your assignment 2A and B makeup exam. So this is the total assets. Okay, you get a total asset, and now I want you to know your total liability and owner's equity, because it has to be balanced, right? It has to be balanced. So you can see your total liability and owner's equity. So the first, I wanted to have your total liability. So the total liability, let's say you have, okay, I wanted to get your total liability, notes payable plus accounts payable plus tax payable plus accruals plus long-term debt. That's your total liability. So you add them up, that's your total liability. Now you have your stockholders' equity. Your total owner's equity is going to common stock plus your retained earnings. That's your total owner's equity. So your total liability and equity, owner's equity, equal to this number plus your total liability. Okay, you see it has to be balanced. The number will be exactly the same. Your total asset equal to your total liability and owner's equity. Okay, now so you wanted to know the weight of each type of asset. Okay, so in this case, so when I give you a balance sheet, okay, ask you to calculate the weighted average cost of capital. So you need to determine the weight from the information you get from the balance sheet. So what is the weight of the debt? Weight of the debt is your total liability. This is your total liability divided by your total asset. Total liability divided by total asset, or divided by the total liability plus owner's equity. Okay, the weight is 26%. 26%. What about the weight of preferred stock? Preferred stock, you don't have any preferred stock. See, there's nothing is preferred stock. If the owners equity, they have preferred stock somewhere here, you need to use the numbers of preferred stock divided by your total asset. Okay, no preferred stock. So the weight of your common stock, this is owner's equity divided by your total asset. Let's give you the weight. Okay. Give you the weight. This is a 74%. Okay, the debt is 26%. So some of the company, they have preferred stock, some of the company, they do not have preferred stock. Okay, make sure you understand where you can get the debt or the weight of debt and the weight of common stock or preferred stock if the information was given in the balance sheet. Okay, now we have, yes, last time we talked about the cost of debt. Okay, the cost of debt. If this is a 10%, so it's after tax cost of debt. And then we have the weight, and then we have the cost of debt. The cost of debt is after using after tax cost of debt. Do not use the cost of debt before tax cost of debt. If the cost is 10%, for example, 10%, and the tax rate is 20%, is 40%, so the after tax cost of debt is going to be the 10% before tax cost of debt times 1 minus 40%. Okay, so the tax rate is 40%. Okay, you need to get the after tax cost of the debt. Okay, for the preferred stock is preferred dividend divided by the preferred stock price. Okay, preferred dividend. We go back to see the preferred stock dividend. Okay, preferred stock is preferred stock dividend divided by the preferred stock price. Okay, $5 dividend. So that dividend is fixed and will never change. It's going to be constant $5 forever. So the preferred stock price is $42. $5 divided by $42. Okay, this will give you the preferred stock dividend. And the weight of common stock. So the common stock, you have a different way to calculate. Okay, different way. Remember, so we have two different way. One is dividend growth model, dividend growth model, and also we have a capital asset pricing model. So you can choose either way and to get the cost of a common stock. For example, you have you got this, and based on what we talk about, so you have a 15%. Okay, how do you get the dividend growth model? Okay. So the cost of common equity, when you use dividend growth model, you can say this is the dividend at the end of the first year divided by current stock price and plus G%. So this is also called Gordon model, a Gordon model for constant dividend growth rate model. This is most of the time students get this question wrong because you notice that this is D1. D1 is D0 times 1 plus G. Okay, D0 plus 1 plus G. So there's a dividend at the end of the first year. It's not current dividend. So if they give you current dividend, $3, you have to calculate the expected dividend at the end of the year. So one time period after current time period. So that is D1. So this is very important for you to know that this is a dividend growth rate model. And then when using that model, you can see you can get the cost of common equity. Cost of common equity. And also you can use the capital asset pricing model. So we just talked about the capital asset pricing model in chapter 7. This is the risk-free rate, and this is the beta, and this is the return on market, and this is the risk-free rate. So for example, estimated beta of a stock is 1.2, the risk-free rate is 5%, and expected market return is 13%. So you can apply this formula, okay, and get the cost of common equity. Some students ask me the question about, can I do both way and take the average? That's not recommend. So you can use either way based on the information you have. You know, sometimes when you do the calculation, they didn't give you what is the dividend growth rate. They give you a market return. So you know that you're gonna use capital asset pricing model. But if they do not have risk-free rate and give you the dividend growth rate, you know, you're gonna use the dividend growth model. So based on what type of information that are given to you. Okay, there another one we didn't talk about last time is if you issue new common stock. Okay, as what I talk about. Okay, the issue new stock. Okay, if you do the debt Okay, debt is the cost lowest, and then preferred stock is higher, and then the common equity is even higher. So we talked about that before. You see the debt, cost of debt, 6%, preferred stock, 12%, common stock, 15%. That's normal. That's okay. That makes sense. And if you you got some common stock, the weight of the cost of common stock is lower than the debt. Okay, that's not normal. Basically, we have a pecking order, and so this common stock is existing stock, the cost of existing stock, or using the cost of retained earnings. It's not new issuing. So if you issue new stock, a new stock is cost even higher than 15%. Okay, so we talk about if you have a new issuing, okay, when you need capital, you have to issue new stock. Remember at the very beginning, we talked about your two types of new issuing, right? The two types of new issuing is one is IPO, okay, initial public offering. And also you have seasonal equity offering, SEO. Seasonal equity offering is also primary market stock issuing. So it is also new stock. So some of the company, they issue stock for the first round, and later on they need more money, and they do seasonal equity offering. So we talk about primary market, including both IPO and SEO. So the new issuing we can do is that we're using this function, okay, the function, and you can see you have current stock price, and you have flotation cost, and also you have flotation cost. So you can get the new issuing cost, okay, new issuing cost. So you can do use this function, okay, use that D1 divided by the current stock price minus flotation cost plus G%, okay, plus G%. So this is we do using this one is for issuing new stock. Okay, let's see how you get this solution. So this is an example. If additional shares are issued, flotation cost will be 12%. The current dividend is $3, and estimate dividend growth rate. Okay, this is G is going to be is 10%. The stock price is $60 at present. So you can calculate D1 and current stock dividend D0 times 1 plus that G%. That's how you get a D1. The D1 is this part. And then you use current stock price, okay, which is $60, and minus 12% of the flotation cost. So how you get this? So it's going to be $60. Okay, so flotation cost. You have okay, you have a $60 times 1 minus 12%. Okay, that's the cost. Okay, when you do that, and then you will see that it's going to be $52.8. Okay, that's how you get $52.8. And then you plus that dividend growth rate, which is 10%. That's the cost of issuing new stock is 16.25%. It's even higher. So we can get this, and you can see the new issuing 16.25. Okay, remember, so we got a different for the cost of common stock. We have a different cost. So you calculate. So based on different type of model, so the cost will be different. So make sure you just choose one of them. Okay, when based on the information you have, just choose one of them. You don't have to take the average or do all these three. Okay, so once you have the cost, okay, and you have the weight, you put in this formula, which is called weighted average cost of capital. Remember last time we talked about how you get to the weighted average cost of capital? We are going to use the function, remember, is called, yes, it's called a sum product. Okay, sum product function. So when you do the sum product, so the cost will be, so let's do here. So the WACC is equal to, okay, WACC is going to be sum product. Okay, sum product. This is the weight. Okay, you select the weight of different type of asset. Okay, so let me go back. Sum product and the open parentheses. You select the weight, and then you go comma, and you select the cost. Okay, select the cost, and you close the parentheses. So this is the formula you see that right here. So you can click on enter. It'll give you the average cost. The average cost of these weighted average cost of capital. This is how you get the weighted average cost of capital. So we have the weight. Okay, we have the weight. Okay, we change this to like a 40%, 10%, and this is a 50%. So you can see the cost is increasing. Okay, as more weight goes to your common stock, the weighted average cost of capital will increase.
Could you repeat the last thing you said?
Huh?
Could you repeat the last thing you said? You said the more weight that goes to your common stock, the WACC increases?
Yes, that's right.
Mhm.
Okay, next the topic is marginal cost of capital. The marginal cost of capital is going to be the weighted average cost will change if one component cost of capital changes. And so that means we wanted to know the WACC of the next dollar of capital raised in, this is a marginal cost of capital. So why this is different? And so for example, you assume that the company has 100,000 in retained earnings. So retained earnings typically cost the lowest, with which to finance as a capital budgeting. So we can calculate the point at which they will need to issue new equity, since we know that the company's desired capital structure calls for 50% of common equity. Okay, if this is the case, and you wanted to know the break point. The break point will be the available retained earnings divided by the percentage of your total. That return earnings in your total capital you raised. So calls for 50% of common equity, that's going to be 100,000 divided by 50%. So the break point is going to be 200,000. So you got 200,000. So that means if you use internal common equity, okay, for the first 200,000, your cost is 11.69%. That's a weighted average cost of capital. If you raise capital beyond that, okay, beyond that 200,000, the cost will go up to the next level. You have to use new common equity. Remember the new common equity, your weighted average cost of capital will increase to 12%. Okay, because this is a, you can see this is going to be is not 15%. It's going to be 16.25%. So that's your weighted average cost capital will increase. And okay, so that's the concept of marginal cost of capital when you make a decision. Okay, any questions? Okay, if you do not have any questions, so we're gonna end the meeting here. Okay, and make sure to find the chat box and type your name. Okay, find the chat box to type your name for attendance. So now I'm going to stop sharing my screen and leave the meeting.